Welcome to Rebank, your front row seat to the future of finance.
Mike Cagney, welcome back to Rebank.
Thanks for having me.
Well, it's great to connect with you again. We had a conversation together with our mutual friend Lex Sokolin probably 4 years ago now. You were still, I guess, relatively earlier in the figure and provenance journey. And man, you know how things have changed. You're a public company now, for one. How was that?
That was a big step. It was something we felt was important to do, something that was very hard to do under the prior SEC and a little bit easier under this one. I had tried to go public, starting back in 23, and given some of the headwinds that we had about how blockchain and crypto heavy the business was, I split the company in two. And so I had Figure and Figure Markets, and I went to be the CEO of Figure Markets, and I brought Mike Tannenbaum in to be the CEO of Figure. And Mike I'd worked with for a long time. He was the chief business officer, revenue officer at SoFi. And he was at Brex as the COO, and I'd been trying to hire him out of there for a couple of years. When I had a chance to bring him in as CEO, it was something appealing enough. He made the jump. And then as we were going through the process, it was clear that we still had a lot of headwinds because even by splitting the business, that they were both still very blockchain intensive. And when Chairman Atkins came into the SEC, we realized we had a slightly different market construct and a different public market appetite as well. And we recombined the business. And when we did that, I asked Mike to stay on as CEO, and I moved into the exec chairman role, where I basically do the same thing I've always done before, which I drive product strategy and direction. I don't have 500 people reporting to me. Mike is much better at that than I am. And so it's a good separation of responsibilities.
Amazing. Well, congratulations on that milestone. But I also know that it's just the beginning. So one of the things that I've heard you say recently is that equities belong on blockchain. I wonder if you want to unpack that a little bit for us.
Yeah, and I think it's a very particular approach and a little bit different than a lot of my peers, in that a lot of people are talking about equities being on blockchain, basically taking DTCC securities that trade on the Nasdaq or the NYSE and tokenizing them, putting them on blockchain, and the idea that 24/7 trading is the value prop there, and 24/7 trading is not in itself that valuable. Market makers generally aren't comfortable making market on public equity off market hours, off New York hours. There is value in 24/7 if you create more of a democratized access to the equity so that you have a global reach versus a regional reach in what you're doing. But to me, I go back to when we started putting credit on chain, loans on chain. There were really three things that we were trying to accomplish. We were trying to get transactional efficiencies. We were trying to get better liquidity, and we were trying to be able to leverage DeFi from a financing standpoint. And I felt that we certainly have demonstrated that on the credit side. So if you look at what we've done with loans, we've cut upwards of 150 basis points of cost out of origination, aggregation, and securitization. We've created what I would consider the only liquid private credit marketplace outside of GSE mortgages. And that's because of how we use blockchain. And then we're leveraging DeFi now and basically using it in lieu of traditional warehouse financing and being able to finance assets cheaper than we can through wholesale financing. And I think that's going to continue. But I've always felt those value props were extensible into equities. And, I had tried to, way back when we started Figure, we get an alternative trading system from the SEC. It basically allows us to run a blockchain marketplace for securities. And it's self-custody, self-settle, works just like a decentralized exchange. Right? It's a little bit interesting in terms of how it was structured, but it's unique in that way. And I felt that we could be able to take equities on chain and get the same value prop, the same transactional liquidity and financing benefits. Initially, as I mentioned earlier, I wanted Figure to go public and go on chain. And at the time that wasn't viable. I had tried to buy Celsius out of bankruptcy because they have this weird Chapter 11 construct where if you emerge out of Chapter 11, you can become a public company without a national registration. And so I didn't need the SEC to sign off on it. And that's, why I was very aggressive trying to get Celsius and also then why I tried to get FTX. FTX eventually didn't lift out. I always felt that there was this value prop and the transactional benefits are relatively straightforward. You can reduce the cost of the transfer agent, for example. You can, as a company, reduce your proxy expenses because you can use wallet as a voting quorum as opposed to sending out snail mail. I used to talk about NASDAQ queues in my personal account. They went through a voting process a couple months back, and I must have gotten 90 pieces of physical mail encouraging me to vote, including about 15 FedEx letters. Would have been a lot easier if they just pushed an NFT to my wallet and said vote here. And so there's some benefits that accrue on the transactional side. As I mentioned, there's liquidity benefits in that you can run 24/7. And again, the real merit of that is if you're providing democratized access. And that's what we're doing with the ATS, in that you don't need an introducing broker. You can actually show up with a wallet, you show up with stablecoin, you show up with the security itself, and you go to the ATS and you trade. And that changes a lot of things in terms of access, and it really opens up and democratizes access. But the key benefit of putting equity on chain is DeFi. And it's really around this idea of being able to take my stock, use it as collateral, cross-collateralize it with things like Bitcoin, where I can't do that today, and create better collateral pools, but also to control stock loan. And one of the biggest economic drivers for prime brokers is the fact that stock loans are a completely obfuscated process. You want to borrow stock to short it, they run a locate process. You don't know what they're paying the person with the stock, you know what you're paying them, and they run a relatively large spread between those two rates. The idea of being able to use DeFi is you can just run a straight lit limit order book for stock loan. So you and I can put our stock out for loan. I want to earn 10%, I get to earn 10%. Everyone can see that. And that, I think, is a huge deal and drives an enormous amount of economic back into the buy side pocket. But for this to work, you can't do a wrapped version of a DTCC security for a couple of reasons. One is the SEC has come out and said, look, if you tokenize a security that trades on the NASDAQ or the NYSE, it's still the security that trades on the NASDAQ or the NYSE, meaning that it has to adhere to Reg NMS for best execution. And what Reg NMS says is when I lift an offer, hit a bid, there isn't an atomic settlement. I'm not hitting any particular bid or lifting any particular offer. I had to go to 8 different pools of liquidity, do what's called sweep the table, where I have to take the best bid or the best offer across those pools. Obviously, in a blockchain construct, a DeFi construct where it's bilateral, I'm facing off to you, and when I lift the offer, I'm lifting your literal offer. That won't work in a Reg NMS construct. And so you can't wrap that security. What you have to do is create a new security, a distinct security that lives on blockchain, that doesn't live on DTCC, it isn't part of the national market exchange. The other reason you have to do that is in terms of collateral, there's a very limited market that will lend against a wrapper versus a very deep market that'll lend against the actual security. And if you actually want to unlock DeFi, you need to have the security on chain. So what we did at the end of last year is we filed an S1 with the SEC, effectively a second IPO, where we said we're going to issue figure equity. We're going to do it native on the blockchain. It is a separate and distinct security from the NASDAQ security. It will trade on our alternative trading system, and you will be able to take it over to Democratized Prime, which is our DeFi protocol, and you'll be able to borrow against it, lend it out, etc. And so it's really an innovative transaction, one that I hope happens in the next week or so, as we're trying to push this to get it done by mid-February. But it's important on a bunch of different dimensions, but most importantly, it won't be the only stock there. So there are other companies behind us that are going to do the same issuance. We'll start building a marketplace. And this is really the first, what I would consider a real challenge to the public equity ecosystem. If you think about what we're doing versus the way that it's been done historically. So, first, there is no DTCC as registry. It's registered on the blockchain. There is no NASDAQ or NYSE. It's trading on, effectively the ATS, but which is really a DEX. There is no introducing broker, no Robinhood, no Schwab, no TD. You just bring your wallet, attach, and trade. There is no prime brokerage or broker margining. You go to DeFi to get your leverage and DeFi to lend your stock out. So there's almost nothing from the existing stack other than the transfer agent that exists in the new stack. And the transfer agent's important because, when we were doing the roadshow for the initial IPO, I was telling all the buy side accounts, look, you really want to own the blockchain version of the security. for the reasons I just walked through. And they said, well, that's great, but what if no one shows up? What if there's no liquidity? What if it trades at a 50% discount? Like what am I going to do? How am I going to get out of the trade? So we worked through a pretty novel way to basically allow you to swap one security for the other. So I can take my blockchain security, I can turn it into the NASDAQ security. I can take the NASDAQ security, I can turn it into blockchain security. And in doing so, we've effectively created the same liquidity across both pools. So, Jump is providing liquidity in the NASDAQ side. They're providing the same level of liquidity over on the blockchain side. And therefore, you have assurances that those two are going to trade in sync because there's an arbitrage that they don't. It'll be picked off. So we're pretty excited about this, and I think this is really the beginning of what I think is a true challenge to the traditional equity ecosystem. And what's interesting is it's global, right? It's not specific to the US. We're already talking to companies in other parts of the world that are looking to do the same type of listing and have the same type of global market access and the same type of blockchain benefits. So obviously you have regional issues that you have to deal with in terms of the domicile those companies are in. But I think this is a foundation really to, first and foremost, introduce this decentralized construct to the equity market, but more importantly, introduce DeFi. And I've been a strong proponent of decentralized finance. To me, it is the most powerful thing about blockchain and why blockchain really matters. And going all the way back to when I started SoFi, my motivation there was directly connecting sources and uses of capital, and that's what I see its core principle DeFi is. And so, being able to bring public equity into the DeFi ecosystem to me is a transformative play.
Amazing. Few follow-up questions. So firstly, on the transfer agent side, is that you or are you working with a third-party transfer agent?
Yeah, we have Figure Equity Solutions, which is a registered TA, and so that's providing the transfer agent services on the blockchain side. We still work with a traditional transfer agent on the public side, although our intent is to swap that out to Figure Equity Solutions as well. Mm-hmm. And effectively, through the TA, we can do a ledger transaction to move the stock across those two networks. And you still have the fact DTC isn't real time, so we can move it as fast as we can move it as it shows up on the register there. But you have that transferability.
Yeah. So during market hours, you think it'll be a relatively quick conversion between the two, and outside of market hours, you're waiting for open?
I think you'll be able to lock the conversion in immediately. It's just the delivery into DTCC is limited to as fast as they can take the registry update, which is generally a business day. But you'll lock the swap, effectively the shares immediately.
Mm-hmm. Do you think there's any chance of like Reg NMS relief or rule change to facilitate on-chain markets?
I think that this is what some people are trying to push for in the Clarity Act. And I think it's a really, really tough road. Reg NMS is a law. If it was an SEC edict that was subject to their interpretation, it could be easier, but it's not. It's a law. It's a law that had best intentions. I don't think necessarily has resulted in the outcome that the lawmakers intended it to have. It was really a result of I don't know if you read the book Flash Boys and the whole issue of front running security transactions and so forth. And so the intent was to protect the investor. It really hasn't done that in my view, but it is a law, and I don't think there's a lot of appetite to overturn that. And I don't think the SEC is in a position to provide exemptive relief to law. As such, I'm not optimistic that you're going to get any wholesale revision or changes on the Reg NMS side. And I think the right way to do it, and anyone who's saying, well, it's the only way it can happen, that's not true. Just look at what we're doing, right? You can do what we're doing. We don't have a monopoly on a company issuing a second public equity. We do have an ATS that's uniquely situated to support it. My expectation is that people will start leaning in this direction in terms of what to do in the public equity side, and moving away from the idea of just tokenizing existing stock.
Mm-hmm. You have such a strong background in kind of traditional institutional markets and connectivity into them today. I wonder how you think about ultimately how this transition is likely to play out. So on the one hand, it's kind of inherent in the innovation phase of the market right now. You have DTC taking one approach where they're basically looking to defend their entrenched position. when many could argue that in a disintermediated world, the requirement for an entity like that is less relevant. You have Kraken, you have Robinhood, you have Ondo, you have Superstate, all taking what seem to be kind of different flavors of more or less the same approach. On the one hand, you have kind of wrapper versions, and on the other hand, you have the sort of transfer agent level issuance creation of tokenized securities. How do you think about how this shakeout is going to happen? How this transition is going to play out? Like how do we get from where we are today to a sort of unified model in the future?
Yeah, so I think you raised a couple of really interesting points. I mean, one, you've seen the announcements from DTCC, from the NASDAQ, from the NYSE. I think some of those announcements were the result of our announcements, and their desire to stay relevant and part of the dialogue. I think the irony or the paradox of that is, to the point you made, you don't actually need them in a blockchain construct. And I bring this point up all the time about lots of different industries. I pick on Visa a lot. I probably shouldn't pick on them so much, but they're always talking about doing blockchain initiatives, and I'm like, well, blockchain really works if stablecoin payments really work. True bilateral transactions, biometrically signed. You don't need the chargeback and reversal services that Visa provides, which is really the value of that network, or at least the value of that is significantly diminished versus what it is today. And it's the same thing. Like, what role does DTCC play in bringing stocks onto blockchain but still custodying them at DTCC? If I'm just wrapping a stock, it's not the stock itself, then, as I mentioned earlier, you have very limited collateral value. You have no governance capability. You have a trust element, but also you're extremely vulnerable to the prediction markets, because why don't you just trade on the prediction markets or trade on the perp markets? Why do you need the wrap version of the stock to trade at all? Because it doesn't mean anything, right? It's no better than trading on a perp or trading, just writing a prediction market. Hey, I think figure will be over $80 by this date, where I get massive leverage in terms of what I can do. And so I don't think that those are viable, sustainable strategies. I think that the prediction markets will ultimately make the wrapping construct irrelevant.
Mhm.
And so you're going to bifurcate into two models, which is, that prediction and maybe perp marketplace, where you're not actually trading the underlying security. You're making a bet on a reference point to that security, or where you're actually issuing the security native on chain. You actually have the asset. You can use it as collateral value. You have the governance that it affords you, and for certain that you have the stock. And the key for that is that security has to be able to trade. And the limit that you have right now is you can't tokenize a NASDAQ security and put it up into a limit order book, because you're violating Reg NMS. And what you need to do is actually create that security native to the blockchain ecosystem, and then you can support a marketplace for it. So I see the rush to tokenize will dissipate into two, somewhat diametrically opposed camps, which is, I don't actually have the stock, I'm betting on the price, and I can do that through prediction or perpetual, or I do have the stock, but it's native on blockchain and it affords all the benefits that I get from it.
Yeah, makes sense. Do you see your ATS ultimately kind of supplanting NASDAQ or NYSE and becoming the default venue? Or do you think that either, one or both of those venues may try to kind of upgrade toward a more tokenized equity future? And or, I don't know, will we have a wide range of different settlement venues that are all interacting in a tokenized equities future?
Yeah, I mean, it raises the question of what is the role of the exchange. And with an ATS, I can't call it an exchange. I have to call it a marketplace because of SEC requirements. But it raises the question of what are these things. So if you look at what the NASDAQ and what the NYSE do, certainly they provide a limit order book and the ability to cross transactions. But a lot of the value they're providing is on the post trade execution, right? The clearing and settlement. Well, you don't have clearing and settlement on blockchain, right? It's a bilateral atomic transaction. As I talked about earlier, when I lift your offer, I lifted your offer. You get the cash, I get the stock, or you get the stablecoin, I get the stock, and the transaction's done. So it introduces this notion of, well, what is the value then of the marketplace, and how valuable is that marketplace? And right now we have a bit of a regulatory moat because we have the ATS to do this, but other people can get it, and I expect other people will get it and lean in. And what we want to avoid is hundreds of pools of fragmented liquidity where you have this issue because you can run convertibility, but trying to run convertibility across 100 different ATSs would be somewhat of a difficult process. Although it could be a brand new revenue stream for Citadel and Jump and others who are just arbitraging across these 100 pools like they do today on the crypto side, right? But we have 2,700 crypto exchanges, and those markets are nowhere near as effective as the public equity markets in the U.S. are with two major exchanges and the OTC market and so forth. So I think that I would expect to see them lean in. But the issue is it challenges their model. So the question is, well, what is their share of economic when all they're providing is the medium to cross limit orders?
I want to get back to the DeFi conversation. Maybe the way to get there is, in practical terms, like what's the KYC model for the tokenized figure equity, and how does that ultimately translate to DeFi interoperability?
Yeah, so FinCEN is very clear about KYC requirements for regulated entities. So we have a broker dealer that sits on top of the ATS, even though it doesn't touch any of the transactions or it's a self-custody, self-settle system. There's still a broker dealer running it. That means anyone attaching to the ATS has to be KYC'd, and so there's a KYC requirement. Where it gets interesting is I now have a digital asset. It's in my wallet. What prevents me from taking it onto Camino and looping it there, right? And why can't I do that? And the traditional position the SEC has taken is, oh, you have to move securities to whitelisted wallets. They've been KYC'd, blah, 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 blah. That's not the SEC's purvey to tell you that, because it's a FinCEN responsibility. It's not an SEC responsibility. And I've made this argument with the SEC, and I think I've been effective making this argument with the SEC. The SEC would then counter and say, oh, but there's a transfer agent requirement. The transfer agent has to get the name and address of the security holder. Now, the transfer agent was never intended to be a KYC AML barrier or gateway. The transfer agent was there to act as a registry for the securities in case they ever got lost or stolen or what have you, but also to identify holders for voting, for proxy and quorum. And you can do all that with a wallet address. In fact, you can do it, as we talked at the beginning of this conversation, much better with a wallet address than you can with, sending out snail mail to a physical address. And so we're making that argument. I don't know that on its own we're going to be effective in making this argument to the SEC. So one of the things that we're doing is pushing in clarity the modernization of the transfer agent provision. Modernization of the transfer agent is, hey, the TA needs to get the wallet address. That's sufficient. And by the way, this federal regulation preempts any state legislation relating to this, because every state has their own transfer agent requirements as well, or nearly every state does. And so I think if we get that, the modernization of the TA and a clear delineation between FinCEN and the SEC and what FinCEN's comfortable with, then I think you do have the ability to take that digital equity in your wallet and take it to any protocol that you want to use it as collateral or trade. You could stand up a AMM pool in Radium, right? There's a lot of interesting things you could do. Now, the company can't pay dividends or do any transfer of value to those shares without knowing who the holder is. But in terms of just trading it as collateral, you should be able to do that. So I think that's where we start opening up some interesting applications in DeFi. And this is something that the regulators really have to lean in and consider, because the problem you have right now is you have this offshore arbitrage, right? So you mentioned some of the folks that are trading stocks right now. They trade stocks for non-US citizens, and they're doing wrappers, and effectively they're running an unregulated securities exchange, and I say that not in the sense that that's a negative or a bad thing. It's just that's what it is, or unregistered. And the issue is if the SEC takes these dogmatic positions, you're going to create this bifurcated marketplace where it happens everywhere outside of the US and doesn't happen in the US. And I think that I think the regulators should think about leveling the playing field and having a uniform regulation and enforcement versus creating this gray market versus onshore market that they've effectively done with what they've done thus far.
Yeah. It seems to me like DeFi is relatively self-contained, with respect to the broader financial market. It's also very clear to me that the future that you're envisioning is one in which DeFi is deeply integrated with the financial system. I wonder if you want to share any thoughts you have on how and where those interconnections are likely to take shape.
Yeah, so I think there's a series of events that are going to happen, and I think this is why the rewards debate on stablecoin is so important. And the Genius Act, I think, set off a series of events that are going to be very hard to reverse, which is people are going to migrate from bank account to stablecoin. And right now, bank accounts, generally don't pay any interest or any rewards. The stable coins are paying rewards or in a roundabout way interest, but at some point they'll just pay explicit interest. That battle is going to be lost on the banking side. And when I can hold a coin in my wallet, I can self-custody it. I can buy coffee, Bitcoin, stock, pay my bills, and it's paying me interest. Like, that's better than a bank account. And I'm going to migrate to that. So you're going to see a flight of liabilities. And the Treasury did a study that said if there were interest-bearing coins, you'd lose $6.8 trillion of deposits out of the banking system that would migrate onto stablecoin. Well, there's about $18 trillion of deposits in the banking system. And in I think early 23, when the Fed began to tighten, we lost about $1 trillion of deposits in the banking system. It absolutely destroyed the credit capital markets. Silicon Valley Bank failed, Signature failed. The FDIC and the Fed had to step in. The FDIC in particular, with extraneous measures about deposit insurance to prevent a bank run. But what was interesting is there were two things that we saw happen. One, we saw deposits leave the system. We also saw deposits move from regional and super regional banks into the money centers, right? JP Morgan was a huge beneficiary of deposit flight, even though on an aggregate level, liabilities went down. And I think you're going to see a rehash of that as stable coins evolve and become used for payments, and you have this ubiquity of usage for them. And that's going to cause a problem in the credit ecosystem the same way it did when that $1 trillion left. But let's say it's $6 trillion, right? The market is not prepared to deal with that. The banks would have to sell so many assets. And what I think will happen is DeFi can step into that void. And notably, you and I pull our deposits out of the bank in the form of stablecoin, but then we go to a DeFi protocol and lend that coin out. And now, the old way, we would keep the money at the bank would lend our money out, and the bank would earn the whole spread, right? So they'd pay us zero. You would pay 10% on the loan. The bank would earn the 10% carry. And that was their economic model. Well, now we can pull our cash out, we can lend it directly, and we might want 6% or 7%. And the borrower might pay 8 or 9%. There's a Pareto condition where everybody's better off removing the bank as the capital allocator in the middle. But the irony is it's the same money that was financing that asset before. So the bank had your loan financed by my liability. I pull my liability out, the bank has to sell that loan. That loan makes its way onto a DeFi protocol where I now lend directly to it, and I'm earning the economic. And this is the evolution that I see happening. And this is where I think DeFi plays an incredibly powerful role. Now, there's a bunch of gating issues here to make this happen. One is the experience. If you look at the wallet experience today, I would say it's generally subpar. I can't tell my dad to download a wallet and go on to DeFi, and so because he wouldn't know what the heck to do, and he'd end up getting hacked and lose all his stuff. Whereas I can tell my dad to download SoFi's app, right, or Robinhood's app, and so we have a gap between the crypto experience, the Web3 experience, and the traditional fintech experience that needs to be closed for broad adoption. Also, DeFi only works if that underlying collateral is liquid. And so you have to create these liquid marketplaces. And this is one of the big things. And I always joke about how I don't get invited to RWA conferences because, people are like, oh, I'm going to take this, office building in Topeka and I'm going to put it on blockchain and finance it on DeFi. And I was like, no, you're not. Like, no one's going to lend against it. There's no liquidity. It's a dumb idea. Don't do this. you have to create a liquid marketplace. And that's what we did with our credit. So, if you look at our loans, Figure HELOC is the 10th largest crypto asset on CoinGecko right now. And it's a liquid market. And it trades every day. The other day, there's $140 million of loans that traded. There's $15 billion of TBL. And you have a liquid marketplace, and that supports it. So there's some heavy lifting to start taking things beyond what Figure's doing with mortgages into auto and unsecured consumer and other types of loans, small business, and creating the liquidity to be able to support that DeFi protocol. But that's a big thing that Figure is doing right now, and you're going to see us start doing branching out well beyond what we do today in mortgage and going into auto and receivables and others, either directly or in partnership with folks, and trying to build these standardized marketplaces that have underlying liquidity so that they are supported in DeFi protocols.
Mm-hmm. All right. So a few follow-up questions there. And maybe the first and most important one, for a smart former bank founder like yourself. So talk about the sort of like fractional reserve money creation side of it, because, sure, maybe today, like there's X amount of dollars and there's X amount of credit assets. And you could imagine a world where dollars flow into stablecoins, which are effectively like purchasing or refinancing existing credit assets. Banks would make the argument that, without the sort of like FDIC/taxpayer backstopped fractional reserve banking model, like you can't sufficiently grow credit creation and therefore fuel economic growth. And that's ultimately the reason that they should be kind of protected in bank deposit versus stablecoin yield battle. What do you make of that?
Yeah. So the key is, and it goes back to what I was talking about earlier, which is the bank has the ability to effectively lever its equity. So the rule of thumb would be 10 to 1, right? So the bank has $1 of equity capital for every $10 of loans it does. The other $9 is financed by deposits. But you still have to finance the loan. You need dollars to fund that loan. It doesn't matter if you then take that loan and put it back to the bank, and the bank lends you $100, you put $100 back to the bank can then lend 90 of that out, and traditional fractional reserve construct, which has a bunch of philosophical or practical flaws to it. But I don't need to go into that in depth. The key is that the bank needs the money to lend. It's not creating money, right? It's using those liabilities to fund those assets. All you're doing is taking those liabilities out and now directly funding those assets unlevered. And what you're doing is creating a massively safer, more stable financial ecosystem, because you don't have that leverage construct. You're not 10 to 1, 20 to 1, 30 to 1 levered, where a minor adjustment in underlying market value, like we saw with Silicon Valley Bank, right? When the agencies they held dropped 10% in price, it bankrupted the bank because they didn't have a sufficient equity cushion. Like, you don't have that problem in unlevered DeFi lending. And so I think what you end up with is actually a much safer, more stable financial system, banking system. And then the idea that, the community banks support particular regions and geographies, and you can do the exact same thing in DeFi, right? So I can stand up a DeFi protocol in Detroit. I can stand up a DeFi protocol in Philadelphia. I can, for people that are in the region who want to lend to people in that region and, align them that way. So there's a lot of things that you can do to, fill the void of what's been perceived it will happen if stablecoin actually comes to fruition.
Yeah. So if you are the CEO of SoFi, just as an example, right? Like fintech bank, very like innovation forward, rapidly scaling. Congratulations. What are you doing now? How are you thinking about the DeFi or on-chain finance opportunity?
Yeah, look, I think Noto is actually pretty progressive as a banker and has been thinking a lot about this. And SoFi's talking about doing their own stable coin, which makes sense. They're providing access to crypto rails. I think that they have aspiration to build the same kind of capital ecosystem that we've been able to build at Figure, right? A blockchain native credit ecosystem, and be able to capture the benefits of that. The big difference between how SoFi is looking at it and how Figure is looking at it is SoFi still embraces this concept of super app, as does Robinhood, as does Coinbase. And, when I started SoFi, that was the whole idea. It was a super app. It was, we're going to build a relationship with a super high value customer. At the time we called them Henrys, the high earner, not rich yet acronym. And we're going to use student loans as our entry point, but then we're going to provide banking, brokerage, wealth management, all these other services into them. And that super app construct made a lot of sense when fintech was building out. With Web3 and wallets, we've been able to look at this in a very different way, which is instead of SoFi holding all my stuff, all my assets, all my liabilities, all my information, I hold it. I have it in my wallet. I self-custody it. And I can go to distributed applications and figure out where I want to trade, where I want to borrow, where I want to lend, and pick the best venues to do that. And so you kind of flip the paradigm from, hey, everything is sitting over at one, entity in the super app to, hey, I now have the ownership and control. I'm carrying it with me and I'm going and deciding what venues I want to participate and transact in. And I think that battle, that struggle, again, is predicated on that wallet experience being better, right? Because it today isn't good enough to compete and do that. But I think that it can be, and we can build in that direction. That to me is going to be the interesting evolution of Web3 versus Web2, right? And if I'm right, the super app goes away and everything becomes wallet centric.
All right. So to wrap up, final question for you. As you look back on Figure to date, it started with HELOCs, blockchain as hidden infrastructure to ultimately create more economical, better performant financial products. You built an SEC regulated or registered yield-bearing stablecoin. You're now, seems like, all in on tokenized equities. What have you learned throughout this journey so far, and how does it inform how you think about the future of the business?
Yeah, I think the thing I've taken away, and I just did a blog post about this on X and LinkedIn a couple of days ago, or yesterday, in fact. The prior regulatory regime was extremely difficult, and we were able to build a lot at Figure despite the regulatory headwinds that we had. But we were trying to do some things like we had the USDF consortium. We were trying to build a yielding tokenized liability deposit with a bunch of banks, and the FDIC came in and said, we're not going to let you do this, right? And it's not blockchain, isn't consistent with safety and soundness. That was in 22. So, think about the huge debate we're having right now on yielding stable coins. And in 22, we had a solution that a bunch of regional banks had bought into and were eager to deploy, and the regulators came and shut it down. And, and so the thing I've taken away is you need the right regulatory backdrop. And the current regulatory regime is much more favorable to blockchain and crypto, but through interpretation, not through law. And so what we have to do is we have to future-proof the space and codify the law. And that's why Genius Act was so important. That's why clarity is so important, because we can't let the future of the ecosystem, the future of the industry be subject to the interpretation of whatever political regime is in place at any particular point in time. We just need it codified as law. And because without that, how do you invest heavy dollars? How do you really build knowing that everything could go away in a year, right? And so to me, under the previous 4 years, I wouldn't even go to Washington, D.C. I was like, there was no point in being there. There's no upside at all. Now I'm spending a lot more time there and pushing this and really advocating, blockchain has real value to real people. Like if you look at what we've done with mortgages, we are turning back on the sub $300,000 mortgage category because of the efficiencies that we get out of blockchain. We've been able to make that loan more affordable, more profitable for the people originating it, where they wouldn't touch it before. And so, being able to go to a senator and say, look, we've done $1 billion of loans in your state, and we've saved your constituents, tens of millions of dollars in interest payment because of DeFi. Right now, they haven't heard those stories. And, it's really important that they do start hearing those stories and hearing how, the technology is more than, a crazy online casino. It's actually substantive and can really improve people's financial positions.
Yeah. Well, Mike, listen, it's amazing to reflect on the conversation that we had, 4 or 5 years ago, the vision that you laid out for Figure and what you thought was possible in this space, now seeing how quickly you've executed on what was a massive vision and how the vision has only expanded. So very impressive what you've built. You're certainly moving this industry forward.
I appreciate you calling it quickly. It seemed like an eternity from my standpoint, but those are blockchain years. So it's they're not measured in normal time.
Mike Cagney, thank you very much for joining us today.
Thanks for having me, Will.